Welcome everyone. Thank you for joining our webinar. My name is Vanessa Abboud. I'm a director here at HLB Manjard and your host this morning. Today we are presenting the financial reporting and tax update presented by your panel of experts, Joel Dare, Carmen Ridley and Michelle Warren, and introducing Natalie Teak, advisor in environmental, social and governance, also known as ESG. Now I'd like to introduce tax consulting partner Joel Dare. Joel is a highly qualified tax practitioner. Through ongoing presentation to members of the Tax Institute and ICAA, Joel has become recognised as an industry thought leader due to his understanding of commercial taxation matters. I would now like to hand it over to Joel, who will provide you with the tax update.
Well, thank you very much, Vanessa, for that kind introduction. It's my pleasure today to be with all of you and also to be a support and warm-up act for Carmen, Michelle and Natalie. So I thought what would be interesting for us to run through today in a little bit of detail are what we call the Next 5,000 review program, which is being run by the Tax Office currently. And I feel it has a particular potential market overlap for people who also have an interest in financial reporting matters. And we'll get to some of the market segment information and who they're looking at, who they're looking at, and will they be looking at you, most importantly. So to go into a little bit of detail about this Tax Office Assurance Program, the Next 5,000, I thought it'd be useful to start off with a little bit of headline around who, when, and what the Tax Office is looking at and about. So in particular, this program is designed to fit in with private groups with wealth in excess of $50 million. And I thought for that reason, it probably has a natural overlap with a lot of the financial reporting type interest clients in terms of their needs. And so it's actually been running for a couple of years now. It's supposed to run for 4 years after 2019, but a little bit of intel on the ground is that the program to date is a little under-resourced and possibly running a little bit behind at the moment. So if you haven't had the good fortune of getting a tap on the shoulder to suggest you are part of the program, it's not exactly free from doubt that you will not get a call in 2022 or 2023 and be asked whether or not, to be required to participate in the assurance program. Just a little bit about the terminology here. Next 5,000. What's the next to? Well, originally this, I suppose, spun out as a lower or a smaller market segment from what we're calling the top 500 program, which the Tax Office is running. So if you have already been touched as part of the top 500 program, which is for taxpayers who typically have a slightly higher wealth and or turnover threshold, then you won't also be part of this program. You don't get to have 2 visits from the Tax Office. No such good fortune. And I suppose what I find potentially most interesting to this audience here, especially when we come to the context of privately held groups, is the type of information that the Tax Office would be looking for as part of their Next 5,000 review. And so I just thought I'd include there on the slide some of those key bits. And the first 2 dot points to me are not all that surprising. They probably match up with a lot of the type of reviews that taxpayers are used to being subject to at the moment in terms of their interactions with the Tax Office. That is that they usually want to see a copy of your group structure and any information that leads into the support of your tax return. But also in that third element there is this idea of tax governance and the provision of tax governance documents. And that's where I suppose I see that there could be potential gaps between what the Tax Office's expectations are of taxpayers in this Next 5,000 group and potentially what type of documentation they have in place currently. So that I just thought it'd be useful to dwell upon a little bit here. What are we talking about when we talk about tax governance? And I suppose what's interesting here is that the tax governance from the ATO's perspective, and they do go into quite a lot of detail on this on the website, what they would like to see by way of tax governance is more around the process. And that, I suppose, for a lot of taxpayers and also their advisors is quite novel. We're used to providing a deliverable to the Tax Office and then providing support information that leads up or supports whatever disclosures are made on the deliverable. To talk about what process leads up to that is perhaps a bit foreign to a lot of potential taxpayers. I guess I see it as being much more common in the large and multinational groups circumstances. If you are in one of those groups where you've got a traditional separation of management and control, often processes will be designed and in place and effective and tested on a regular basis to assess what kind of risks, including tax risks, are undertaken and what kind of processes are used to manage those risks. Now, that won't always be the case in privately held groups. So a little bit more information here about this idea of tax governance. So what the tax office is looking to, I suppose, dig into here as part of the next 5,000 review is to understand the design of your tax governance framework, and that idea of design. So somewhere where management takes control and has a capability of identifying tax risks. So they will need to understand what roles and responsibilities exist within an organisation in terms of recognising tax risks. And look, there's quite a lot of discussion on the tax office website around what type of things they would like to see. Processes and controls in the preparation of your income tax return. So there's some nifty little flowcharts on the tax office website that suggest, if you like, an ideal state of how it is that processes such as income tax returns or business activity statements are prepared and the controls that are involved in that. And also that you have processes and controls in place to escalate or identify issues or tax governance issues or tax risks within your organization, so that there is a process which is identifiable and documented that actually identifies those tax risks and specifies what actions need to be taken in it. Now, depending on the size of your organization and the level of sophistication of a finance function, you might already have all of that in place. But if not, I suppose what I'd be pointing out here is that if you do think that you're in that target market for the next 5,000 review, then it might be time to have a look at your tax governance and see whether or not it is subject to the review in this period or at a later time if your documentation and process actually matches up with what the tax office would be looking for. Now, why is this potentially more of an issue for the next 5,000 group? Well, typically speaking, what I'd say here is that it's almost as though the tax office has taken a level of tax governance which is applicable to that separation of management control and swept it down into the privately held market. And for that reason, I suppose I can see that there are quite significant possibilities for a gap between what the tax office wants to see or expects that a privately held group would have and what they actually do in practice and what they have documented, most importantly. And so for that reason, I suppose what we're seeing is that in some cases, you won't be able to easily get through the tax office scrutiny without perhaps upskilling or having a good review, and also perhaps upping the level of documentation that you have in place for things such as tax return processes and also tax risk management. So identifying areas where, as a matter of course, you go and seek advice to manage tax risks that emerge within your business. I thought I might wrap it up on this slide of some key learnings from interactions that have been had in terms of this next 5,000 group that as we're already a little way through it. I suppose a first thing there would be, if any of this sounds a little concerning, it's not actually intended to be, because what you can see helpfully on the tax office website, there's quite a lot of detail set out there about tax governance. Some flow charts around like an ideal process map for conducting income tax returns, what they consider controls to be for tax, and also key things that they expect to review as part of their processes. And a key one to that will always be, what is your economic performance and how does it compare to your performance for tax purposes? Can you explain those key differences? Other things that we have had as sort of part of our experience with the next 5,000 is that we know that this program, although intended to stretch out to 5,000 taxpayers and to be a relatively intensive process, is effectively under-resourced at the moment. And what we're seeing is there that the focus tends to be, if you have a number of entities within your economic group, especially for privately held, there's typically speaking a great deal of focus on a central entity or a couple of central entities. It may not cover the entirety of your group. Also that because of the lack of resources that are involved, it's intended to be an assurance product. So it looks at trying to achieve that assurance around taxpayer behaviour in a period of 4 months. So it's designed to be quite a short interaction. which frankly is probably a little bit reassuring. We also know that the tax office at the moment in these next 5,000 reviews is particularly interested, because it's a private group situation, in the interaction between whatever the economic entity is and related parties, especially in relation to things like loans. But also there's a bit of an interaction there around the private use of assets that are held within that group. So if you do have those type of situations in place, if you do get a next 5,000 review, or even if you don't, it's a very good opportunity to have a look at how the private use of assets within an economic group or a series of businesses is documented, and if necessary, go and obtain some advice about why you've got the right outcomes and they don't lead to unexpected outcomes for either the business or its associates. We do know that this program's both under-resourced and running a little bit behind at the moment. So I suppose, like all things, that could be code for subject to the political process. And we know we're all experiencing that firsthand at the moment, to see exactly where that program goes to for the rest of this year in 2023, because it will take additional special funding to actually complete. And look, that was the conclusion of my part of the presentation this morning. But please, for anyone who has any interest in this, please feel to get in touch, or alternatively, please put in your Q&A so that we can all enjoy the benefit of questions, which probably a lot of other people might have about this program at the moment. Thanks very much, and I will hand it back to Carmen, Michelle, and Vanessa.
Thank you, Joel, for your update. I would now like to introduce Carmen Ridley and Michelle Warren. Carmen is a member of GAAP Consulting Network and principal of Australian Financial Reporting Solutions, and specialises in financial reporting advice, accounting standards interpretations, technical training, and financial statement reviews. She has excellent knowledge of financial reporting through significant experience with several major accounting firms in both external audit and technical divisions, and spending significant time analysing and interpreting accounting standards for clients. I would also like to introduce Michelle Warren, who is our National Financial Reporting Director here at HLB Manjard. She provides leadership on financial reporting matters across the HLB Manjard Australasian network. This includes overseeing the network's thought leadership on financial reporting issues and developing and delivering training content to meet the financial reporting needs of network firms. Without further ado, I'll now hand it over to Carmen.
Right. Actually, it's Michelle. Hi, everyone. No problems. Thank you, Vanessa. Hi, everyone, and welcome to what I would say is the most exciting bit of today's session, the financial reporting bits. For the next roughly 40 minutes, Carmen and I will be covering a range of topics. I'll be pointing out the new accounting standards that apply for the first time for 30 June 2022. I'll spend a few minutes reminding everyone that the end of special purpose financial statements is here for many for-profit private sector entities, and who those for-profit private sector entities are. I'll also cover recent ASIC restatements, so you are aware of these when you're preparing your 30 June 2022 financial statements. And then I'll finish off with a not-for-profit update before handing over to Carmen, who will talk to some of the recurring accounting themes that she has seen in the last few months. Right, starting off with the new accounting standards that we will need to deal with at 30 June 2022. You'll be very pleased to know that from an international perspective, similar to last year, there's really not much happening. So no major new standards that have been issued by the International Accounting Standards Board that are effective for the first time for 30 June 2022. In terms of Australian specific standards, however, depending on the type of entity you are, you could have quite a bit of change to deal with. You could have minor disclosure related changes to deal with, or you could have no change at all. The hardest hitting new accounting standard is the first one on the slide, AASB 2020-2. I'll talk to this a bit more on the next slide, but certain for-profit private sector entities that currently prepare special purpose accounts can no longer do so because of this standard. So these are the entities that will have the most change to deal with, as they'll have to prepare general purpose accounts from 30 June 2022 year ends onwards. These entities will have a choice. So either tier 1 or Tier 2 general purpose accounts, although most of these entities will not have public accountability. So Tier 1 or full-blown IFRS accounts would probably be excessive. They will most likely prepare Tier 2 accounts applying the new Tier 2 simplified disclosures framework, which has, of course, replaced the previous Tier 2 RDR framework. And all the disclosure and presentation requirements for this new Tier 2 simplified disclosures framework are contained in a new standalone standard AASB 1060, which is the second standard listed on the slide there. AASB 2020-9 relates to a few disclosure changes to the new Tier 2 simplified disclosure requirements because of the reform of certain major interest rate benchmarks, such as interbank offered rates, which I don't think will be relevant for many of you, so I'll just skip right along. The last standard, AASB 2021-3, won't be of much consequences, I don't think, because lessees that were given deferrals and rent waivers by their landlords due to the pandemic probably early adopted the initial rent concession practical expedient offered by AASB 2020-7, which was issued back in 2020. So as a reminder, this practical expedient that I'm talking about effectively gave lessees the option to treat COVID-related rent concessions not as lease modifications, which involves a fair amount of work, but rather as variable lease payments, provided certain requirements were met. The use of this and the initial standard will drop off anyway, as the practical expedient has a limited life because it cannot be applied to rent concessions post 30 June 2022. Now, I don't want to harp on much about the end of special purpose financial statements because I feel like Carmen and I have been banging on about this for the last 2 or 3 years now. However, I do still get a number of queries on this topic, particularly around scope of the reforms and who can and who can't prepare special purpose financial statements. Now, I always say to whoever's asking me, apart from being a for-profit private sector entity, doesn't really matter what type of entity you are, there are just 2 conditions to consider in all cases. The first one on the left, any legislative requirements to prepare financial statements that comply with Australian accounting standards or accounting standards. The second is any non-statutory requirements to prepare financial statements that comply with Australian accounting standards, where that relevant document, such as a constituting or other document, was created on or after 1 July 2021, or it was created before 1 July 2021, but it is then changed subsequently, and that reference to Australian accounting standards is retained in the document. Now, if either one of these requirements applies, and the entity in question is a for-profit private sector entity, then that entity will have to prepare general purpose accounts for years ending 30 June 2022 onwards. And of course, general purpose financial statement means compliance with all the recognition and measurement requirements of all the accounting standards that apply to the entity, including consolidation and equity accounting. Now, at the same time that marks the end of special purpose financial statements for certain for-profit private sector entities, a new Tier 2 framework called the Simplified Disclosures Framework has been introduced. So this provides a general purpose framework for entities no longer permitted to prepare special purpose financial statements from 30 June 2022. Also, those entities that currently prepare RDR financial statements, whether you're for-profit or not-for-profit, will need to migrate to simplified disclosures as RDR no longer exists. So for these entities, any change would be limited to disclosure only, as you would already be applying all the recognition and measurement requirements of accounting standards. And even then, the difference in disclosures between RDR and simplified disclosures would probably not cause a massive amount of work. So to recap, if you're a for-profit private sector entity that needs to prepare general purpose financial statements for the first time, the upcoming June year end probably will involve some work for you. And really, the amount of work involved will very much depend on the extent to which you currently comply with all the relevant recognition and measurement requirements of the accounting standards, as well as your current level of special purpose disclosures. Those entities currently preparing RDR financial statements at the moment, there might only be a slight change in disclosures for you as you move over to simplified disclosures, but really nothing to get too excited about. Now, something to perhaps get a bit excited about if you are a financial services licensee. My message to you today is that AFSLs are caught by these reforms, and they will have to prepare general purpose financial statements from 30 June 2022, regardless of the size of the entity or the nature of the financial statement users. Now, ASIC is going to issue a policy statement that will give AFSLs guidance on whether they need to prepare Tier 1 GPFS or Tier 2 GPFS. My understanding is that AFSLs will have to apply the public accountability test using the definition of public accountability in AASB 1053. So if you have public accountability, Tier 1 GPFS. If you do not have public accountability, you will be able to prepare Tier 2 general purpose financial statements. But then there's going to be certain categories of licensees, for example, those that deal in financial products or hold client monies, that will automatically fall into Tier 1, which means they will have to prepare Tier 1 general purpose financial statements. So we need to wait for ASIC's guidance regarding Tier 1 versus Tier 2 for AFSLs, which I believe is going to be issued very soon. But the bottom line is general purpose financial statements will be required for all AFSLs from 30 June 2022 onwards. Right, for those for-profit entities that are allowed to continue to prepare special purpose accounts, there is a bit of change for you in the form of a few additional disclosures. Which for-profit entities am I referring to? It's those that are required by their constituting or other document, like a trust deed or a loan agreement, to prepare financial statements that comply with Australian accounting standards, where that document was prepared before 1 July 2021 and has not been changed at all after that date. So even though such an entity's reporting requirements require compliance with Australian accounting standards, these entities get to continue to prepare special purpose financial statements, but then they will have to include these extra disclosures in their financial reports. And the purpose of the disclosures is to make the basis of preparation very clear where a special purpose report refers to Australian accounting standards. So what are the extra disclosures? First off, the reason that special purpose financial statements are prepared. So this could be, for example, because the directors believe all the users in the financial statements can ask the entity to prepare reports that meet their particular information needs. All the material accounting policies used to prepare the set of accounts must be disclosed, as well as any changes in those policies. Where those material accounting policies do not comply with the recognition and measurement requirements in Australian accounting standards, it must be disclosed how they do not comply. So depending on the extent of non-compliance, this particular disclosure may look different for different entities. For example, if there are only 2 recognition and measurement requirements you don't comply with, you could easily just list these 2 instances of non-compliance in the basis of preparation note. However, if there are a number of recognition and measurement requirements you don't comply with, it would probably be better to explain how you don't comply in the relevant accounting policies. So for example, if you don't capitalize operating leases as a lessee, assuming this is material to the financial statements, you'd state your policy is to recognize operating lease payments on a straight line basis over the lease period. And then you'd add in a sentence, this is not in compliance with AASB 16 leases. Where the entity has interests in other entities, it must disclose whether the consolidation and equity accounting requirements have been applied. And then finally, where there are no instances of non-compliance with the recognition and measurement requirements, an explicit statement must be made that The financial report complies with all the recognition and measurement requirements of Australian accounting standards. Alternatively, as soon as there is at least one instance of non-compliance, an explicit statement is needed that says the financial report does not comply with all the R&M requirements of Australian accounting standards. So the standard that will mandate these additional disclosures has not yet been issued, but it is expected to be issued this month. These disclosures will be required in 30 June 2022 financial statements, special purpose financial statements, and every year thereafter, while the entity's non-statutory reporting requirements continue to reference Australian accounting standards, and the entity continues to prepare special purpose accounts. All right, moving on to what ASIC has been up to of late. There's not too much to report other than just point out some of the recent ASIC restatements. Interestingly, the issues highlighted by the restatements on this slide are pretty much the same as those highlighted in our November updates, impairment and provisions. So probably a good idea to pay attention to these areas when preparing your 30 June 2022 accounts. I'll quickly just run through them. Collection House reminds us to pay attention to deferred tax assets. In this case, ASIC questioned the reasonability of assumptions about future profits against which recognized tax losses could be utilized. Considering the 2 years we've just experienced, company performance has probably not been as expected in many cases. And any uncertainties caused by the ongoing impacts of the pandemic must be factored into the assessment around probability of future taxable profits. And also just remember, adequate disclosure must be made about what supports the recognition of a deferred tax asset where an entity has been in a loss-making position for a few years. Buddy Technologies was called out for using very optimistic revenue growth forecasts to value its goodwill, despite reporting negative revenue growth that particular year. So as always, ASIC is paying attention to the assumptions used in impairment calculations. So directors and preparers must ensure that things like revenue growth rates used in the models are supportable when compared to actual and historical data. A similar lesson can be learned from Oliver's Real Foods because the assumptions about future sales performance used in the impairment models were not reasonable when compared to actual performance. ASIC also felt that the effects of COVID, such as extended lockdowns post-year end, had not been adequately considered. Now, hopefully there is less uncertainty to deal with at 30 June 2022, as we all seem to be emerging from the pandemic. But there are certainly still things to think about when it comes to the impairment of assets. For example, the likelihood of suppressed trading conditions for a period of time before hitting those pre-COVID trading levels again. In terms of provisions, Woodside Petroleum had underprovided for future costs to retire offshore oil rigs and related infrastructure. So this is all to do with an understated restoration or rehabilitation provision. Now, many of you will not have oil rigs on your books, but many of you are lessees, party to lease arrangements that very often put a contractual obligation on the lessee to return the leased asset to its original condition at the end of the lease. These make good provisions, as they are called, are similar in nature to a rehabilitation provision. And so any future costs you expect to incur in making good the asset must be provided for under AASB 137, the provision standard. So please watch out for these. Have a good read of your lease agreements and make sure any necessary make good provisions are recognized when necessary. For the not-for-profits listening today, there are some important changes that affect charities registered with the ACNC for the 30 June 2022 financial year. So first off, the thresholds that determine a charity size have been increased. So charities must use these revised thresholds for purposes of their 2022 annual information statements and financial reports. Under the new thresholds, A small charity is one with annual revenue of less than $500,000, up from $250,000. A medium charity is one with annual revenue of between $500,000 and $3 million. And a large charity is one with annual revenue of more than $3 million. So in terms of implications, those charities that move from being medium to large will no longer have to prepare, lodge, and have audited or reviewed a financial report. They will just be required to submit an annual information statement to the ACNC. Those entities that move from being large to medium, they will still have to prepare and lodge a financial report with the ACNC. The difference is that they can now choose to have this report either reviewed or audited. And of course, any charities that remain classified as large will have no change to their current reporting requirements. They must still prepare and lodge an audited financial report with the ACNC. So please be mindful of these changes and consider how this affects your reporting obligations for the upcoming June reporting period. Registered charities will also have some new disclosures to contend with this year. So these disclosures relate to key management personnel, or KMP, remuneration. Key management personnel are the people that are responsible for planning, directing, and controlling the activities of an entity. So in a not-for-profit context, this would be the responsible persons and senior executives that are responsible for running that charity. So directors, board members, trustees, the CEO, the COO, the general manager, etc. Now, charities currently preparing general purpose financial statements under either Tier 1 or Tier 2 are not affected by this because these entities would already be making these disclosures. So Tier 1 entities will already be applying AASB 124, the related party standard, while Tier 2 entities will be applying the related party section of AASB 1060, the simplified disclosure standard. There's also no change for small and medium charities that prepare special purpose financial statements. These entities are not required to disclose KMP remuneration. It's only large charities that prepare special purpose financial statements that have more than one remunerated KMP that are impacted. So these large charities will have to make the new disclosures applying either AASB 124 or paragraphs 193 to 196 of AASB 1060. The only difference between the two is that AASB 124 is slightly more onerous in that it requires disaggregation of remuneration disclosures, whereas AASB 1060 doesn't. But the ACNC Commissioner has used discretion and said that even when an entity applies AASB 124, it can just show the total amount of consideration instead of showing subtotals for the different remuneration categories required by AASB 124. So at the end of the day, there's no difference whether you apply AASB 124 or the equivalent requirements of AASB 1060 for the purpose of making these disclosures. Just take note that where the KMP services are provided by a separate management entity, like an accounting firm, the amount incurred for these services must be disclosed separately in the financial statements. The disclosures must be made for years ending 30 June 2022 and thereafter, and there is no need to show comparative amounts in the first year of making these disclosures. However, comparatives will be needed in subsequent years. The ACNC has recently issued some guidance around these disclosures, so please refer to the ACNC website if you need more information, or feel free to contact your local HLB person. Just a heads up, from 30 June 2023, medium and large charities will have to make related party disclosures in their special purpose accounts. We'll cover this in the November financial reporting update, but in the meantime, charities should start having a think about how their systems may need to change to be able to collate the information needed to make these related party disclosures. And that's it from me. Carmen, I hand over to you.
Fantastic. Thanks, Michelle. So we've just heard from Michelle about how there isn't any major changes that were happening. So consequently, what we decided to do this time is to give you a bit of an insight into where I am spending my time. So I get a fair number of queries from a range of different entities, and the issues generally seem to follow a certain theme. I seem to get bombarded with certain queries on a certain topic. So we thought if we talk about it, then maybe for some of you, it may actually prompt a consideration on certain things. So the first one is our accounting for investments. We obviously have different types of investments that you could have. You could have a passive investment, which is where effectively you've got 10 shares in Qantas. You don't have the ability to have significant influence. You don't have the ability to rock up at the board meeting and demand a seat at that table. So we just account for that in our financial instrument standard. We then vary throughout about the level of influence, the level of control that we have. So we move to an associate, which is where we've got significant influence. We then can have joint control and have a joint arrangement. And in that joint arrangement, it may be a joint venture or a joint operation. And then we may have complete control, and therefore we have a subsidiary. So the queries that I'm getting, and I think partly it's to do with the conversation that Michelle's just had around moving to general purpose financial statements. And Michelle talked about how we needed to have the consolidation rules had to be accounted for. So as more entities are starting to look at their structure, they're realizing that potentially we may have to consolidate, we may need to equity account. So if we look at this, we say, what does it mean to have control? What does it mean to have significant influence? We love numbers in the roles that we do, and we want to go, if we own X%, then it must mean we control. And if we own Y%, then it must mean we have significant influence. AASB 128, which is our standard that deals with associates and equity accounting, is one of the very few bright lines that we have within the standards. So it does say that if you have 20% voting interest, you would be expected that you would have significant influence. However, there may be situations where you don't have significant influence with more than 20%, or situations where you might still have significant influence, even though it's less than 20%. Few of the queries that I've been receiving, particularly in relation to this, is where you might have board members and you've got the right to appoint a board member, even though your voting interest might be less than the 20%, or where there are board members in common. So it may be that, for example, your CEO is a board member on a different entity. Did you have the right to do that because of the shareholdings you've got in that particular investment? And ASIC have certainly challenged a few entities on that, where prima facie, it looks like you've had the ability, you've got a shareholding, you've had the ability to appoint. I can't give you an answer because it very much depends on facts and circumstances. So it's really drilling down and really understanding, did you have the right to put that person on? Or is it just that that person is so well respected in the industry and has got so much knowledge that they were actually appointed in their own right? So that's our 20% that we can use as kind of a bright line, but it can vary either side of it. Then we start looking at the 50%, and everyone wants a number of 50%. If it's 50%, we control. If it's less than 50%, we don't. That doesn't exist. So there is no bright line about the amount of voting interest that you need to have to indicate control. So what we have to look at is the definition of control. And I've got that in my subsidiary section there. So there's three components of it. Do you have power? Do you have the power over the relevant activities? So if we think about an entity, they will all have different relevant activities. A relevant activity is what makes them money. So if it was a retailer, it's about what are we selling? What goods are we selling? What price point are we at? Who are we aiming at? So who's making those decisions? If it was a property developer, it's around, again, the price point. It's around what the apartments might look like. It's around the location. Who's making those key decisions around that? Regardless of the share ownership, I might have 35% voting interest in a particular entity. And the remaining 65% is made up of 1,000 different investors. So even though I don't have 50%, I've got a fair amount of power over that entity because it needs a lot of you to act together to be able to outvote me. So we have to make sure that we remove that percentage from our minds, and we're looking very much at power. We then have to look at, do we have exposure to variable returns? If you own shares in an entity, you've got exposure to variable returns because you've got the potential of dividends, you've got the potential of those shares going up in value or down in value. The third component is we have to look and say, because of the power that we've got, do we have the ability to affect those returns? So what ability have we actually got over those decisions? Generally, the hardest one we have is around, do we have the power and making those judgmental decisions? We have to, in many cases, look very, very closely into the terms and conditions of particular agreements. So I've seen a number of situations where it looks like prima facie we've got two parties working together and we're happily working together. However, when you drill into the terms of the agreement, I have the casting vote. So if I don't like what you're proposing, I will slam my fist on the table and use that casting vote, which actually means I have the power. You can't get anything through unless I'm happy with that. So if we've got that joint ownership, it looks like the 50-50, we automatically want to go, well, it must be a joint arrangement. It must be in my blue box. It must be that we're working together. But a real joint arrangement is where both parties can block the decisions of another one. So if you and I are both in a situation where we've got 50% and it needs a 50% vote to get through or 51% vote to get through, it means we can both block the decisions of the other party. Whereas if one of us has the ability to slam the fist on the table and say, not a chance, that's not going through, we can't have that joint arrangement. So as we're exploring, as we're getting into some more often weird and wonderful corporate structures, and we've seen during COVID, there's been a number of entities who have not been able to carry on. And we've seen a lot of mergers and acquisitions that have happened, looking very clearly at the structure of those organizations and what does it mean for your group and what does it mean for the accounting. We often don't think about that. So that's my first one. I've had a huge number, probably more queries in the last 12 months on this control significant influence than I had even when the new standard came out. So something's happening to get people to start thinking about this. So just strongly encouraging you to look at your group structure and really understand which, I'll call it a box, even though it's not square, which box does your investment fit into? The next one, and we've talked about this briefly in some other sessions, but I'm actually starting to get more queries on this again in the last month or so than when this agenda decision came out. So this is something that I've had a few people say to me, there's a major new standard that's come out all about intangible assets and all about software. There isn't a major new standard. Michelle's talked to us about the standards that have come out. What happened is that we have a thing called the International Interpretations Committee, and that sits kind of underneath the International Board, and they deal with specific queries that people have where they might have identified certain inconsistencies or some things that need clarity. This particular group look at the issues, and often what they do is issue what they call an agenda decision. And it says, we've looked at your question. We actually think the standards are quite clear. So we're not going to put it onto our agenda. That's where the agenda decision comes in. But this is what we pretty much think the answer is. Now, that's great. It's really helpful. And traditionally, those agenda decisions are looked at by people like Michelle and I. The techies are all over this. Nobody else takes any notice of them until one comes out that puts the cat amongst the pigeons. Because they are not changes in standards, they don't have an effective date, which means we're not telling you there's something that's coming out that's going to be effective in 2-3 years' time, because what they're saying is we think the answer's clear in the standards. So therefore, it's effective immediately. So what happened is the query that went into the International Interpretations Committee was around software as a service. Now, the committee answer the question they've been asked. This could be equally applicable to a range of other areas. So don't just think we don't do software as a service, just think about some other things it could be applicable for. So the customers entered a software as a service arrangement with a supplier. So they've got the right to access the application software. Let's call it Excel, because we all know Excel, we all know Microsoft. So let's talk about that as I talk through this example. I've got Excel on my machine. I want Excel to look prettier. I want, when I open it up, I want it to kind of have certain inputs, and I want it to automatically suck the data that I'm inputting into the field behind the scenes into the Excel spreadsheet. So it does look differently now when I open Excel. And obviously I incurred a fair amount of costs to do that because I'm a little bit of a clueless technology person. So I had to pay somebody to do that. So the question that was asked was, how do we account for those particular costs that we've just incurred? We know we have to expense the access to Excel on a monthly basis, but what about those costs? Is that an intangible? So that's what went through. Let's have a look at what the International Committee came back with. I've turned their answer into a decision tree. They didn't come up with a decision tree. I've turned their answer into a decision tree. So there's a lot of depends. Those of you who've heard me talk lots in the past, my favorite answer to every question is it depends. There's lots of it depends in here. So the first question that we need to ask is really try and understand what have we done. So that configuration, that customization that we put behind the scenes, do we control the code to that? Can we pull out what we've done? And can we sell it to somebody else? Or is it so intrinsically linked to Excel that actually we can't pull it apart? We can't sell it without having Excel attached to that. Where does the code sit? Is it behind our firewall or is it behind Microsoft's firewall? If we say, yes, we have this thing we can pull apart, it's behind our firewall, we can trundle around and we can sell it to other people, we might have an intangible asset. So we're going down that yes side. Don't see that very often. More likely than I'm coming down the no side. And the agenda decision said, we don't have an intangible asset. So whatever you've got, it's not an intangible asset. The next question we have to ask is who provided those services? Was it provided by, in our example, Microsoft, or was it provided by random IT person? If random IT person did it, then we go down the no mark because it's not the software owner, it's not a subcontractor of Microsoft. And we expense those costs when we've received the service. So once they've built the beautiful code, which means Excel looks really pretty, then I expense that. If Microsoft or an agent of Microsoft did it, I then have another question. Are those services distinct? Now I've got a reference to note 1. Note 1 is on the next slide, but I'm not going to talk about that now. We'll get onto that in a second. So when I'm looking at it being distinct, am I looking effectively to say, well, the configuration or the customization costs were to get the information from my old system onto Excel. And I paid Microsoft to do that. And it was a very distinct service because once the information's on my system, it's there. I don't need to do anything with that. So if the answer is yes, it's distinct, I jump into that same box as if random IT person did it. I expense the costs when I've got the benefit of, or when that service has been completed. If not, if it wasn't distinct, if the thing that they've done for me is an ongoing, and again, so intrinsically linked with Excel that it can't be pulled out, it can't be separated, I really need it to be able to access Excel, then what I'm likely to have is a prepayment. And that prepayment sits as an asset on the balance sheet and gets released over the life that I'm expecting to use Excel. So lots of different potential answers under this one. My key message to you is if you have any capitalized costs in relation to software, configuration, customization type costs, even things like I was asked a question in relation to a registered training organization who had the ability to use training from somewhere else and they tailored it. Similar thing, it's the tailoring costs. The only reason we talk about software as a service is because that's the specific question that was asked. So if you've got any of these assets, please make sure that you've looked at it. Please make sure that your accounting treatment is appropriate. So on the next slide, we'll look at, this is kind of a bit of a decision tree again about whether the service is distinct. I'm not going to talk through this slide, it's more there as a reference. And I think what is going to happen is you will have certain elements that say, yes, it's distinct, and certain elements that you'll say, no, it's not. So it will come down to a judgment decision. If I'm on the fence, which side of the fence is most compelling? And have we documented that particular decision? So a little bit of work there if you do have any of those capitalized software assets to think about. My next one, crypto assets. So something that, you know, quite possibly I'd tried to stick my head in the sand and ignore the fact that this weird and wonderful world of crypto was occurring that I had nothing to do with and had no idea what on earth it was talking about. Unfortunately, however, I can no longer stick my head in the sand because I'm getting lots and lots of queries on crypto assets, how to deal with it. I've learned more about crypto than I have in the last couple of months than I have ever. So it is something that we do need to be thinking about. We are seeing more entities who are potentially accepting cryptocurrencies as payment for their services. We're seeing a number of entities who have decided to jump on the bandwagon and start mining cryptocurrency. And how do we deal with that? So a couple of different issues that I've been getting. The first is, what are we doing if we have actually got a crypto holding? So if we're accepting or we've decided to invest in crypto, I've got this thing, which, I can't hold. Got my hand out as if I can hold it, but you can't hold it. What is it? We're probably confident it is an asset because it has got some future value. But what actually is it and how do I account for it? So there's a few things that have come out. There is no explicit standard on this, unfortunately. It is something that I think the International Board will end up adding to the agenda, but we all know that the standards boards don't move very quickly. We are not going to have a standard on this in the next 6 months. So therefore, we're going to be stuck in this position that we have to figure out what we're doing. So we look and we say, okay, what type of asset have we got? There was a paper that was put out by the IASB a few years ago, and there has also been an international agenda decision, another one of those agenda decisions back in 2019. And that worked through a little bit of a thought process to kind of say, in most cases, we don't think it's a financial asset. It may be inventory, depends on what you're holding it for, and it depends whether you classify yourself as a commodity broker trade or a broker trader, or it may be an intangible asset. So if you have these holdings, we have to make sure that we are drilling down and looking at the definition of each of those types of assets in the relevant standards and understanding the terms and conditions, if we can call them that, behind the crypto. Because what I have learned is there are lots of different types of crypto, and each of them, some of them might be collateral backed, some of them may be fully collateralized, some of them might not. Some of them are just some weird and wonderful thing that somebody has created. The level of trading on each of these is also very different. So even if we determine, okay, we've got an intangible asset, do we hold it at cost or do we hold it at fair value? The standard says if there is an active market, you can hold them at fair value. And traditionally, we've always said very few intangible assets would have an active market. That was pre-crypto. What does an active market mean? If I've got a crypto and there's some trading, but not a huge amount of trading, does that mean it's active? If I've got something like a Bitcoin or an Ethereum, probably argue it's an active market. There are billions of dollars worth of trades on those in a 24-hour period. So lots of judgments that are going to happen, and we will start to see much more guidance coming out around this. But very much if you are holding any of these, there's a fair bit of work to work through and understand what the accounting treatment is. They're very volatile in many cases as well. So if you're holding at fair value, you could have huge fluctuations that are going through your financial statements. The other issue is around the people who entered the scary world of mining crypto. And what does that actually mean? And if we say that we've mined it to be an inventory, what's that cost of inventory? Because we've got all this immense processing power to do that, but how can we allocate the amount of cost that was specifically allocated to the coin or the token that we've mined? Because there's lots of unsuccessful mining, and occasionally we're successful and a token or a coin is spat out. I know it's not actually physically spat out, but that's what we're looking at. If I issue a crypto, so if I issue a coin or a token, what am I giving the holder? What am I giving the holder the right to do? Am I giving them the right to access future goods or services? So in which case, do I have a performance obligation? So make sure that we think very carefully. Often, if we are issuing these through an initial coin offering or an ICO, the white papers that go out are very vague and really don't tell a lot of information. So my key message on this one is if you are entering the weird and wonderful world of crypto, please don't forget that there are quite significant accounting issues, and we need to make sure that we've got that on board, because you could end up with very, very different answers as you work through this. AASB 15 and revenue recognition. So those of you who have been with us on the journey over the last few years probably got sick to death with Michelle and I talking about revenue lots at every single session. I'm not going to talk through the theory of revenue. I've just put this up as a bit of a prompter for you. We made the comment when we've talked about this that we didn't think necessarily people gave AASB 15 the attention it deserved at the time that this standard came in. And we're starting to see the outcome of that now. We are seeing lots of changes that go through. We're seeing entities who are having to change their accounting policy. Interestingly, a lot of the queries I'm seeing around this is to do with the Great Resignation. Whether it exists or whether it doesn't, there is huge staff movements. And lots of queries I'm getting is where a new CFO has come in to a particular entity and has looked at how the entity has been recognising the revenue and gone, just doesn't seem right, just doesn't seem to comply with the standard. And in many cases, that's what we're finding, that it doesn't comply. So I just want to remind you, whilst this is a year of not a lot of change, it is a great opportunity to look back at your revenue and probably your lease accounting to say, does it make sense? If I look at this 5-step process, the areas that people struggle with the most is performance obligations. We are still seeing lots of situations where entities are not appropriately identifying performance obligations. They're the distinct promises. They are not things like, I've got money on an upfront fee, because that won't meet the definition of a performance obligation. We're seeing things around principal versus agency. So do I have the responsibility to provide the goods or services? Do they get control gets transferred to me? Or is my role purely just to arrange some of these to happen? We're also seeing issues about revenue recognition. So step 5 of this process, there are still a significant number of entities who used to do percentage of completion, and we're adamant they weren't stopping doing percentage of completion, but didn't necessarily work through the steps in AASB 15 to see whether that is still appropriate. So they're the two, if you were to say to me, which areas do I think the most challenges are? It's that step 2, performance obligations, and it's step 5 about revenue recognition. So my key message from this one is, please make sure that your revenue recognition methodology firstly has been documented. Very rare that I actually see it being documented, other than a real boilerplate accounting policy disclosure in the financials. And secondly, does it comply with AASB 15? And thirdly, if we have undertaken any new types of contracts since we first looked at AASB 15, have we actually looked at the new contracts and made sure that they comply and they're in appropriate methodology? The last bit I'm going to talk about, which will lead beautifully on to Natalie and her presentation, is to do with sustainability standards. So the reason that I'm talking about it here is because in Australia, it is the Australian Accounting Standards Board that has taken on this role of the sustainability standards. Internationally, it was announced back in November at the COP26 that there was going to be a new international standards board that dealt with sustainability. So it's been called the ISSB, and that sits under the same umbrella organization as the International Accounting Standards Board. So it's in that same place. Consequently, there's a lot of interaction happening between the International Standards Board and the ISSB. Now, I made the comment earlier that standards boards don't move very quickly. These guys are moving very quickly. They were only announced that they were being established in November. They have already, on the 30th of March, issued 2 exposure drafts. That is phenomenally quick, and it's expected that quite possibly they may issue a standard before the end of this year. So my role today is just to highlight the fact that 2 exposure drafts have been issued. First one is quite a generic one that talks about what material risks do you face as an entity in relation to sustainability, and have you disclosed that? The second one is particularly around climate risk, and particularly has a few industries that it identifies and has specific risks that those industries have to do. In Australia, as I said, the IASB has taken this on board and they have issued an exposure draft, and I've put here, it's a wraparound. So what they've done is they've issued the international exposure drafts, and then they've put Australian specific stuff around it to say, given the laws and the regulations we have, do you think any of these conflict with this? Do you think we should make it mandatory within Australia? There's talk about whether internationally these might be mandatory or whether they will be best practice. So I would encourage you, if you are interested in this, please have a look at it. Put in a comment to the Australian Accounting Standards Board. You can see our comment period ends a couple of weeks before the international one, just to give time for them to write their comments. So it is an area that is moving very, very quickly. And I suspect that next time we talk to you, we'll be talking about standards that are out there, may or may not be mandatory, but certainly I think even if they're best practice, will come almost mandated best practice very, very quickly. So that's all I had to talk about. So I'm going to hand over to Vanessa, I think, back to introduce
Correct.
Natalie.
Thank you very much, Carmen. Next up, we have Natalie Teak. Natalie is a member of our corporate advisory team here at HLB Mann Judd in Sydney, and has extensive experience advising clients on a wide range of accounting, corporate and business analysis matters, with an emphasis of mergers and acquisitions, financial modelling, valuations and impact measurement. Natalie also has a strong interest in ESG and sustainability, and helping clients on their ESG journey, from taking the first step through to developing an ESG or carbon footprint plan and assisting in the implementation of and reporting on these plans. Over to you, Natalie.
Thanks, Vanessa. So today I'm just here to provide a quick, brief intro to ESG, including what it is, why it's important, some of the benefits for companies who choose to do something about ESG, and how to start on that journey. So first off, what is ESG? I'm sure many of you are hearing the buzzwords, ESG and sustainability at work, in the media, but what does it actually mean? So we can see on the slide that ESG stands for environmental, social and governance, and the impact of business operations on these factors. So this criteria helps evaluate how a business is doing in regards to sustainability. So then what is sustainability? Sustainability is one of those topics which I find a bit harder to actually define. However, I'm sure we all are aware of what it sort of is. However, one definition that I fall back to is that sustainability is the ability to maintain healthy environmental, social, and economic systems in balance indefinitely. So from a business perspective, this means doing business without negatively impacting on the environment, community, or society as a whole. So now you might be wondering, what is the difference between ESG and sustainability? They are quite similar and often they are used interchangeably. However, if I were to differentiate between the two, I would say that sustainability is a bit more broad and captures all efforts to do better, whereas ESG splits these sustainability efforts into those three pillars of environmental, social, and governance. So then, why is it important? The importance around ESG is largely around stakeholders. So stakeholders are demanding greater transparency from businesses in regards to what they're doing about ESG. And when I say stakeholders, this is not just limited to investors, shareholders and regulators, but it's also including lenders, customers and staff. I'd like to highlight that it's not the regulators who are really driving this need for ESG at the moment. As Carmen mentioned, it's definitely just in the talks at the moment and it's not mandated. However, from what we can see happening in other jurisdictions in Europe and the USA, it will be only a matter of time before it does become mandated, and especially with that ISSB now operating. So one of the key issues at the moment, which is driving this stakeholder demand and the move to businesses to be doing something about ESG, can be tied back to climate change. And climate change now is not limited to the E in ESG anymore. Of course, climate change is an environmental consideration, which can be seen in the extreme weather patterns that we've seen on the East Coast in Australia recently, such as the flooding. However, the impacts of climate change also extends to the social pillar, such as impacting those communities who are facing those extreme weather patterns, and also governance by the increased pressure for organisations to report on what they're doing to address climate-related risks, noting that climate-related risk disclosure will soon likely be mandated, as we are seeing in places such as Europe. So whether it be climate change or stakeholder demand in general, it's clear ESG is important. But if an organisation is not technically required to do something about ESG, why do it? So as you can see on the slide, there are many benefits for businesses who choose to adopt an ESG policy, which I like to group as funding, competitiveness, and staff. In terms of funding, I'm sure everyone has heard of the term responsible investing, which is spoken about a lot. Essentially, investors are increasingly looking to invest into companies based on their ESG performance. So if an organisation can demonstrate it is doing something about ESG, this may increase access to funding from investors with sustainability-focused mandates or just general interest. The next group of benefits falls under competitiveness, and this can cover a lot of aspects, but I've just highlighted a few key ones on the slide. So as I've discussed, stakeholder demand is increasing. So businesses who respond to this demand by doing something about ESG and communicating this to stakeholders will increase their brand and reputation within the marketplace. It's also common for organisations who are tendering for projects or contracts to be required to include a section on ESG and what they're doing in the space. For example, large companies, some large companies are moving to those net zero targets for themselves. And as they do so, they'll be increasingly looking to their supplier chain and demand similar action be taken by their suppliers. So a business with an ESG policy is better positioned to win these types of contracts. ESG action can also lead to long-term cost savings, either directly or indirectly. And of course, this will vary between business and industries. As an example of direct cost savings, any ESG initiatives which lead to a reduction of electricity bills will clearly save some money. But then there are also some cost savings to be had in a general improvement in productivity that might result from ESG action. One example being more engaged staff or reduced turnover, which leads into the next benefit of staff. So as Carmen touched on, a lot of organisations, well, they're facing an extremely difficult labour market with a lot of movement between jobs, and a lot of companies are facing a general shortage of staff. With the increased awareness around ESG and the general perception being that companies should be doing something, those who choose to adopt an ESG policy and communicate this might actually turn out to be a strategy that results in attracting and retaining staff, which could be very helpful in today's environment. So it's clear there are many benefits for businesses which choose to do something about ESG now, even though it's not yet mandated. But I could quite as easily frame those benefits as risks if ESG action is not taken. Sooner or later, action and reporting will be mandated. So starting now can tap into those benefits, or at least reduce the likelihood of those benefits turning into risks in the future. So that might all sound well and good, but where do we start? ESG is a very broad topic, and it can definitely be daunting to know where to start. And I'd just also like to note that many businesses are probably already doing some ESG related initiatives and therefore have started on the journey. So that might make it a little less daunting. But in the short term, it's important to understand where you are now and perhaps consider some small wins that your organisation could take to improve its position from where it is today going forward. For example, many businesses are likely doing something about modern slavery and perhaps addressing issues such as gender equality or giving back to the community in general. So a first step could be to document these initiatives into an ESG plan and start this communication both internally and externally. In terms of small wins in the short term, perhaps an easier place to start would be reducing impact on the environment. And the good news is there's lots of things that can be done, and some are probably already in action in a lot of companies. For example, action could be taken to reduce electricity usage generally, or the business can engage with their electricity provider to go onto a greener option, which would look to source electricity from renewable sources rather than fossil fuels. Another idea may be to reduce the use of single-use plastics, such as by replacing plastic cutlery with more sustainable options, or encouraging the use of keep cups within the organisation. So longer term action would include developing and actioning an ESG and carbon footprint plan. So things to note when developing these plans is to ensure that it includes specific actions that will help the organisation, help improve the organisation's impact, and ensure that these actions have KPIs to monitor the progress. Reporting is also key, and communication to stakeholders, both internally and externally. So on to the next slide, please. What is HLB doing on ESG? HLB Sydney is part of HLB Global Group, offering ESG and sustainability services to clients. So as part of this global initiative, HLB can help out with aspects of ESG, which are highlighted on the slide, including strategy and reporting, carbon footprint strategy and reporting, sustainable supply chain, or program development and delivery. And we're also just happy to chat generally about ESG in your business. So hopefully this presentation has given you a bit of insight into what ESG is, why it's important and its benefits, and will either prompt you to start having this conversation or encourage you to continue this conversation within your organisation. So I'll hand over to Vanessa.
Thank you, Natalie. We'll now open the session to Q&A. Please remember that you can type your questions into the Q&A box found on your Zoom control panel. So first question, so we've got two questions at the moment. First question directed at Michelle. Can companies simply just choose not to prepare financial statements at all and simply rely on their management accounts, i.e. Xero, QBO, MyOb, etc., to satisfy tax preparation and other obligations?
I want to say it depends, but I assume in this case that this company has got no legislative or non-statutory obligation to prepare financials. So something like a small proprietary limited, I'm assuming in this case, if that's the case, there's no requirement to prepare financials. So yes, for tax preparation purposes, they could use their management accounts.
Excellent. I hope that answers that question.
Hope my assumption is right.
Does the requirement to produce general purpose financial statements apply to a corporate authorised representative of an AFSL?
Okay, I'm going to hazard a guess for this one. I would say, Carmen, feel free to tell me if I'm right. I would say it's the license holder that will have the obligation to prepare general purpose financial statements, which stems from the form FS 70. So, but let's hope ASIC addresses this explicitly in the guidance that they're about to issue. So yeah, Carmen, you got any thoughts on this?
Yeah, look, I would agree with you. I think it's one of those areas where there's a lot of questions around this, but my understanding is that it's the FS 70 that is going to have that. It's going to require compliance with accounting standards. So as Michelle mentioned earlier, there is guidance coming on this. If you look at your current FS 70, it does not require compliance with accounting standards. The 30 June 22 one will, and hopefully when ASIC release that, they will put out guidance that will deal with a lot of these questions, because unfortunately, by May 22, we should have had answers to a lot of these. The timing is not great.
Okay, excellent. So that's all we had in Q&A. So before we conclude our webinar, I wanted to draw your attention to the bottom line, issue 12. This is a publication which is written by Michelle, which aims to keep you in the loop with all the latest accounting and financial reporting developments and the potential impact they may have on your business. Michelle, would you care to comment on what the current issue is about?
Sure. Just looking at the topics there, I note that this edition of the bottom line basically expands on everything we've covered today. So if you'd like some more detail, please have a read. The piece on the end of special purpose reporting might be helpful if you currently prepare special purpose accounts and have not yet considered if and how you are impacted by the reforms. We just give you a few things to think about in there. And then linking to what Nat spoke about today, the feature article touches on the importance of incorporating ESG into corporate strategy and decision-making. And the way things are going, this is probably no longer reserved just for the big end of town. The reality is entities of all shapes and sizes will need to start thinking about ESG if they wish to future-proof themselves. So yes, happy reading.
Thank you, Michelle. And that's the end of our presentation. I would like to thank our panelists this morning. Thanks again for joining us today, and we'll see you next time.